Question 1. The risk matrix shows a potential for significant business interruption, claims arising from a cyber attack on a niche online subscription service that operates on a tiered membership model with variable add-on services. The policy wording for calculating the indemnity period and the loss of gross profit is standard, but the insurer's claims handler is considering using a simplified historical average revenue calculation. Despite the policyholder having provided detailed projections and evidence of recent rapid growth in specific high-margin add-on services that were directly impacted by the cyber attack, what is the most appropriate approach for the claims handler to take in calculating the business interruption loss? Option A. Use a calculation method that incorporates the policyholder's detailed evidence of recent growth and the specific impact of the cyber attack on high-margin services, ensuring the method aligns with the policy's intent and is transparently communicated. Option B. Use a calculation method based on industry benchmarks for online subscription services, as the specific details of this business are complex and difficult to verify. Option C. Apply a simplified historical average revenue calculation, as this is a common method for similar businesses and will expedite the claims process. Option D. Select a calculation method that prioritizes minimizing the insurer's payout, as the policyholder's projections are inherently speculative. The correct answer is A. Use a calculation method that incorporates the policyholder's detailed evidence of recent growth and the specific impact of the cyber attack on high-margin services, ensuring the method aligns with the policy's intent and is transparently communicated. Explanation. This scenario presents a professional challenge because the underwriter must balance the insurer's financial interests with the policyholder's reasonable expectations and the ethical obligation to act with integrity. The core of the dilemma lies in interpreting the business interruption policy's coverage for a unique, non-standard business operation where traditional calculation methods may not be directly applicable. The underwriter's duty is to apply the policy terms fairly and transparently, avoiding any misrepresentation or unfair treatment. The correct approach involves a thorough, documented investigation into the specific nature of the business and its revenue streams, followed by a reasoned application of the policy's defined calculation methods, or a justifiable deviation with clear policyholder consent and regulatory awareness. This aligns with the principles of good faith and fair dealing expected in insurance contracts. Specifically, it requires the underwriter to 1. Understand the policy's wording regarding how gross profit or revenue is to be calculated, including any definitions or exclusions. 2. Investigate the policyholder's business operations to gather evidence of actual revenue and expenses that would be used in the calculation. 3. Apply the chosen calculation method consistently and transparently, providing clear explanations to the policyholder. This approach upholds regulatory requirements for fair claims handling and demonstrates ethical conduct by ensuring the policyholder receives the benefit of their insurance cover as intended, even in complex circumstances. An incorrect approach would be to arbitrarily select a calculation method that minimizes the payout without a clear basis in the policy or evidence. This could involve 1. Applying a standard industry calculation method that is demonstrably unsuitable for the specific business type, leading to an inaccurate and unfair assessment of loss. This fails to meet the duty of care and could be seen as misrepresenting the policy's coverage. 2. Relying solely on the underwriter's subjective judgment or internal targets for claim payouts, disregarding the policyholder's actual financial performance and the policy's contractual terms. This breaches the duty of good faith and could lead to regulatory sanctions for unfair claims practices. 3. Pressuring the policyholder to accept a calculation method that is not fully explained or justified, potentially exploiting their lack of insurance expertise. This is ethically unsound and may violate consumer protection regulations. The professional decision-making process for similar situations should involve a structured approach. 1. Fully understand the policy wording and relevant regulatory guidance. 2. Conduct a comprehensive factual investigation of the loss in the policyholder's business. 3. Identify all potentially applicable calculation methods within the policy. 4. Evaluate the suitability of each method based on the facts and the policy's intent. 5. Consult with internal experts or legal counsel if the situation is novel or complex. 6. Communicate transparently and collaboratively with the policyholder, explaining the chosen method and its justification. 7. Document all decisions and rationale thoroughly. Question 2. The monitoring system demonstrates that a business interruption claim is being processed. The claims handler is considering whether to calculate the lost profits based on when cash was received or when revenue was earned and expenses were incurred. Which accounting approach best reflects the financial reality of the business's loss for the purpose of a business interruption insurance claim under UK regulatory guidelines? Option A. A simplified cash-based calculation focusing only on the period immediately following the interruption. Option B. Accrual accounting, recognizing revenue when earned and expenses when incurred. Option C. A hybrid approach that prioritizes immediate cash inflows over earned revenue. Option D. Cash accounting, recognizing revenue only when cash is received and expenses only when cash is paid. Correct answer is B. Accrual accounting, recognizing revenue when earned and expenses when incurred. Explanation. This scenario is professionally challenging because accurately assessing business interruption claims requires a precise understanding of financial reporting principles, specifically the distinction between accrual and cash accounting. The insurer must determine the true financial impact of the interruption, which necessitates a method that reflects the economic reality of the business's operations rather than just cash inflows and outflows. The correct approach involves using accrual accounting principles. Accrual accounting recognizes revenue when earned and expenses when incurred, regardless of when cash is exchanged. For a business interruption claim, this means calculating lost profits based on revenue that would have been earned and expenses that would have been incurred during the period of interruption, even if the cash for that revenue had not yet been received or the cash for those expenses had not yet been paid. This aligns with the fundamental principle of indemnity in insurance, which aims to restore the insured to their pre-loss financial position. Regulatory frameworks governing insurance claims, such as those overseen by the Financial Conduct Authority, FCA in the UK, emphasize fair treatment of customers and accurate claims settlement, which inherently requires adherence to sound accounting principles that reflect the true financial impact. An incorrect approach would be to solely rely on cash accounting. Cash accounting recognizes revenue only when cash is received and expenses only when cash is paid. This method would fail to capture the full extent of the business's lost earnings and incurred costs during the interruption period. For instance, revenue from sales made on credit before the interruption but collected after would be misattributed, and expenses incurred but not yet paid would be ignored, leading to an underestimation of the loss. This would violate the principle of indemnity and could lead to an unfair settlement, potentially breaching regulatory obligations related to fair claims handling and customer protection. Another incorrect approach would be to arbitrarily select a period for calculation without a clear basis, such as focusing only on the immediate cash balance. This lacks a systematic and justifiable methodology, failing to account for the ongoing nature of business operations and the timing of revenue and expense recognition. Such an arbitrary method would not reflect the true financial impact of the interruption and would be inconsistent with the principles of sound financial assessment and regulatory expectations for claims handling. The professional decision-making process for similar situations should involve 1. Identifying the core financial reporting principle relevant to the claim, accrual vs. cash accounting. 2. Understanding the policy wording and its implications for financial loss calculation. 3. Consulting relevant accounting standards and regulatory guidance. 4. Applying the chosen accounting method consistently and transparently to accurately reflect the financial impact of the insured event. 5. Communicating the methodology clearly to the insured. Question 3. Governance review demonstrates that a business interruption insurance claim has been lodged following a period of significant disruption to the policyholder's operations. The insurer's initial assessment, based on a strict interpretation of the policy wording, suggests the claim may not be covered. However, the policyholder argues that the marketing materials and pre-contractual discussions emphasized broad coverage for operational disruptions. Which approach best aligns with the legal and regulatory framework governing business interruption insurance in the UK? Option A. Adhere strictly to the literal interpretation of the policy wording, denying the claim if it falls outside this narrow interpretation, regardless of marketing materials or customer expectations. Option B. Inform the policyholder that the claim is likely to be rejected and cease all further communication on the matter. Option C. Immediately offer a minimal settlement to the policyholder to avoid protracted dispute, even if it does not fully reflect the potential loss. Option D. Conduct a thorough review of the policy wording, considering the specific circumstances of the claim, and assess whether the insurer's interpretation aligns with the reasonable expectations of the policyholder, taking into account any pre-contractual information and FCA guidance on fair treatment of customers. The correct answer is A. Adhere strictly to the literal interpretation of the policy wording, denying the claim if it falls outside this narrow interpretation, regardless of marketing materials or customer expectations. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the regulatory framework governing business interruption insurance, specifically the FCA's Conduct of Business Sourcebook, COBS, and the principles of treating customers fairly. The challenge lies in balancing the insurer's need to adhere to policy wordings and underwriting principles with the customer's expectation of fair treatment and clear communication, especially when the policy's application is complex. Careful judgment is required to ensure that the insurer's actions are not only legally compliant, but also ethically sound and aligned with regulatory expectations for consumer protection. The correct approach involves a thorough review of the policy wording in conjunction with the specific circumstances of the business interruption claim, considering the FCA's guidance on handling claims fairly and transparently. This includes assessing whether the policy wording, as interpreted by the insurer, aligns with the reasonable expectations of a policyholder, particularly in light of any marketing or pre-contractual information provided. The regulatory justification stems from COB 6.1.1R, which mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. Furthermore, the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, are paramount. This approach ensures that the insurer is not unfairly denying a claim based on an overly restrictive interpretation of the policy, thereby treating the customer unfairly. An incorrect approach that relies solely on a narrow, literal interpretation of the policy wording, without considering the broader context or the FCA's principles of fair treatment, would be professionally unacceptable. This failure would violate COB 6.1.1R and Principle 6, as it prioritizes the insurer's commercial interest over the customer's interest in fair dealing. Another incorrect approach, which involves delaying the claims process unnecessarily or providing misleading information about the claim's status, would breach COB 6.1.4R information about the firm, its services and remuneration, and Principle 7, as it fails to communicate clearly and in a way that is fair, clear, and not misleading. A third incorrect approach, which involves offering a settlement that is significantly below the likely value of the claim without clear justification or explanation, would also contravene Principle 6 and COB 6.1.1R by failing to act in the customer's best interests and treat them fairly. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the relevant regulatory obligations, including the FCA Handbook, COBS, Principles for Businesses. This should be followed by a factual assessment of the claim against the policy terms and conditions, always considering the customer's perspective and reasonable expectations. If there is ambiguity or a potential for unfairness, the professional should escalate the matter for further review, seeking clarification on regulatory expectations and best practices for treating customers fairly. The ultimate goal is to reach a resolution that is both compliant with the policy and the law, and demonstrably fair to the policyholder. Question 4. Benchmark analysis indicates that a business interruption event has significantly impacted a company's inventory. The company has historically used different inventory valuation methods for its various product lines, leading to potential inconsistencies in calculating the value of lost stock. The insurer requires a single, consistent method for the business interruption claim to ensure accurate indemnity. Given the company's operational data and the need for a fair and stable valuation, which inventory valuation method is most appropriate for determining the value of the lost inventory in a business interruption insurance claim? Option A, LIFO, last in, first out. Option B, weighted average. Option C, a combination of FIFO and LIFO based on product line. Option D, FIFO, first in, first out. The correct answer is B, weighted average. Explanation. This scenario presents a professional challenge because the choice of inventory valuation method significantly impacts the reported value of inventory, which in turn affects the calculation of business interruption losses. Under the Business Interruption Insurance Certificate Framework, the insurer and the insured must agree on a consistent and justifiable method for valuing lost inventory to ensure a fair and accurate indemnity. The challenge lies in selecting a method that accurately reflects the economic reality of the business's operations and aligns with the policy's intent to restore the insured to their pre-loss financial position, while also adhering to relevant accounting standards and regulatory expectations for insurance claims. The correct approach involves using the weighted average method for inventory valuation. This method is preferred because it smooths out fluctuations in inventory costs over time, providing a more representative average cost for inventory items. In the context of business interruption, where the goal is to determine the value of inventory lost due to the interruption, the weighted average provides a more stable and defensible basis for calculating the loss compared to methods that can be more volatile. Regulatory frameworks and accounting standards generally support the use of methods that provide a fair reflection of inventory value, and the weighted average often achieves this by averaging costs, thus avoiding distortions that can arise from assuming the most recently purchased or oldest inventory was lost. This aligns with the principle of indemnity, ensuring the insured is compensated for the actual value of the lost stock. Using the FIFO, first in, first out, method for inventory valuation in this context would be incorrect. FIFO assumes that the oldest inventory items are sold first. In a period of rising prices, FIFO would result in a lower cost of goods sold and a higher ending inventory value. For business interruption claims, this could lead to an overstatement of the lost inventory value if the most recently acquired, higher-cost items were assumed to be lost, or an understatement if older, lower-cost items were assumed lost. This inconsistency can create disputes and fail to accurately reflect the economic loss. Similarly, employing the LIFO, last-in, first-out method would also be incorrect. LIFO assumes that the most recently purchased inventory items are sold first. In a period of rising prices, LIFO results in a higher cost of goods sold and a lower ending inventory value. If LIFO were used for business interruption claims, it could lead to an understatement of the lost inventory value, as it would attribute the lowest costs to the inventory on hand. This would not provide adequate indemnity to the insured, failing to restore them to their pre-loss financial position. The professional decision-making process for similar situations requires a thorough understanding of the policy wording, the insured's accounting practices, and the applicable regulatory and accounting standards. Professionals must first identify the inventory valuation method currently used by the insured. Then, they should assess whether this method is appropriate for calculating business interruption losses, considering the principles of indemnity and consistency. If the current method is deemed unsuitable or could lead to an inaccurate claim, professionals should consult with the insured and potentially their accountants to determine the most appropriate and defensible valuation method, such as the weighted average, that aligns with both the policy and regulatory expectations. Transparency and clear communication with all parties are crucial throughout this process. Question 5. Market research demonstrates that businesses increasingly rely on complex global supply chains, with some operating with single, critical suppliers for essential components. A client operating a manufacturing business in the UK, insured under a business interruption insurance certificate, informs their broker that their sole supplier of a vital raw material, located in a different country, has ceased operations due to a localized, non-physical event, e.g., a government-imposed moratorium on exports. This has halted the client's manufacturing process, leading to a significant loss of income. The client believes their business interruption policy should cover this loss. Considering the typical structure of UK business interruption insurance certificates, which of the following approaches best reflects the professional duty of the insurance broker? Option A. Inform the client that, as there is no physical damage to their premises, the business interruption policy is irrelevant and they should seek alternative forms of insurance. Option B. Advise the client that business interruption insurance typically only covers losses arising from physical damage to the insured's premises, and that this scenario, lacking physical damage, is unlikely to be covered, while also checking for any specific supply chain or contingent BI extensions that might apply. Option C. Advise the client that the business interruption policy will automatically cover the loss due to the reliance on a single supplier, as this constitutes a critical operational failure. Option D. Immediately confirm to the client that the business interruption policy will cover the loss because the business has suffered a significant interruption and loss of income, regardless of the cause. The correct answer is B. Advise the client that business interruption insurance typically only covers losses arising from physical damage to the insured's premises, and that this scenario, lacking physical damage, is unlikely to be covered, while also checking for any specific supply chain or contingent BI extensions that might apply. Explanation: this scenario is professionally challenging because it requires the insurance professional to navigate the intricate interplay between standard business interruption, by policy coverage extensions and specific exclusions, particularly when faced with a novel or evolving business operation. The core difficulty lies in accurately interpreting policy wording in the context of a business that may not fit neatly into predefined categories, demanding a deep understanding of both the policy's intent and the client's actual operational risks. Careful judgment is required to avoid both underinsuring the client, leading to potential claims disputes and reputational damage, and overinsuring them, resulting in unnecessary premium costs. The correct approach involves a thorough review of the policy's BI coverage extensions, such as those for denial of access or prevention of access, and critically assessing whether the client's specific circumstances, including the reliance on a single, non-traditional supplier, fall within the scope of these extensions. This requires understanding the policy's definitions of damage and interruption, and how they apply to a supply chain disruption that doesn't involve physical damage to the insured's premises. The professional must then meticulously examine the policy's exclusions, particularly any related to supply chain failures, reliance on third parties, or consequential losses not directly tied to physical damage. The regulatory framework for business interruption insurance certificates mandates that policyholders are provided with clear and accurate information regarding their coverage. Therefore, advising the client based on a comprehensive understanding of both extensions and exclusions, and clearly communicating the limitations of coverage, aligns with the duty of care and the principles of fair dealing expected of insurance professionals. An incorrect approach would be to assume that a supply chain disruption automatically triggers a BI extension without a detailed policy review. This fails to acknowledge that BI policies are typically triggered by physical damage to the insured's property or premises, or by specific, defined extensions. Relying solely on the existence of a BI extension without verifying its applicability to the specific cause of loss, a non-physical supply chain failure, is a regulatory failure, as it misrepresents the coverage available. Another incorrect approach is to dismiss the scenario entirely based on a superficial reading of exclusions, without first exploring potential coverage extensions. While exclusions are critical, a professional duty exists to explore all avenues of potential coverage for the client. Failing to do so, and thereby potentially leaving the client uninsured for a significant risk, could be seen as a breach of professional duty and a failure to act in the client's best interests. A third incorrect approach would be to advise the client that the policy will cover the loss simply because it's a significant business interruption, without a detailed analysis of the policy wording. This is a misrepresentation of coverage and a direct violation of regulatory requirements that prohibit misleading statements about insurance products. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's business and risk. Gain a comprehensive understanding of the client's operations, including their supply chain dependencies and potential points of failure. 2. Policy wording analysis. Conduct a meticulous review of the business interruption policy, paying close attention to definition, coverage extensions, e.g., denial of access, prevention of access, contingent BI, and exclusions. 3. Risk-loss correlation. Determine if the identified risk reliance on a single supplier aligns with any triggers for coverage extension, considering the specific wording of the policy. 4. Exclusion scrutiny. Critically evaluate all relevant exclusions to ascertain if they preclude coverage for the specific scenario. 5. Client communication. Clearly and transparently communicate to the client the extent of coverage, including any limitations or potential gaps, and recommend appropriate risk management strategies or alternative insurance solutions if necessary. Question 6. Process analysis reveals that a retail business experienced a significant interruption due to a localized flood. The insurer is reviewing the claim for business interruption, Which approach to expense analysis best aligns with the principles of business interruption insurance and regulatory expectations for fair claims handling? Option A. Identifying and classifying expenses that would have continued to be incurred by the business during the indemnity period, irrespective of the interruption, as fixed expenses, and those that would have ceased or reduced due to the lack of operations as variable expenses. Option B. Classifying all operating expenses as fixed, as they are necessary for the business to function. Option C. Treating all expenses that continue for more than 1 month after the interruption as fixed, regardless of their nature. Option D. Excluding all expenses not directly related to sales, as the primary loss is lost revenue. The correct answer is B. Classifying all operating expenses as fixed, as they are necessary for the business to function. Explanation. This scenario is professionally challenging because accurately classifying expenses for business interruption insurance claims requires a nuanced understanding of both accounting principles and the specific policy wording. The insurer must distinguish between expenses that would have continued regardless of the interruption, fixed, and those that would have ceased or reduced, variable. Misclassification can lead to underpayment or overpayment of claims, impacting the insured's ability to recover and the insurer's financial stability. Careful judgment is required to interpret the policy's definitions and apply them to the specific circumstances of the business. The correct approach involves meticulously analyzing each expense item against the policy's definition of gross profit or revenue, and the insurer's duty to indemnify the insured for losses incurred due to the interruption. This means identifying expenses that are directly tied to the continuation of the business operations that were interrupted. For example, if a business is forced to close due to a fire, rent and salaries of essential staff would likely be considered fixed and recoverable, whereas raw material costs or sales commissions would be variable and not recoverable, as they would cease with production and sales. This aligns with the regulatory framework's emphasis on fair claims handling and ensuring the insured is placed in the financial position they would have been in had the loss not occurred. An incorrect approach would be to broadly categorize all operating expenses as fixed, without considering whether they would have ceased or reduced during the period of interruption. This fails to adhere to the principle of indemnity, as it would allow the insured to recover expenses they would not have incurred anyway, effectively providing a profit. This is a regulatory failure as it contravenes the spirit and letter of business interruption insurance, which is designed to cover lost profits and continuing expenses, not to create a windfall. Another incorrect approach would be to classify all expenses that continue for a short period after the interruption as fixed, without a clear justification based on the policy or the nature of the business. This could lead to the inclusion of expenses that are truly variable and would have been avoided had the interruption been prolonged. This is an ethical failure as it demonstrates a lack of due diligence and potentially exploits ambiguity in the policy to the detriment of the insured. A further incorrect approach would be to exclude all expenses that are not directly related to the production of goods or services, even if they are demonstrably continuing costs necessary for the business to resume operations. This overlooks the fact that business interruption insurance covers not only lost profits, but also continuing expenses that are essential for the business's survival and eventual recovery. This is a regulatory failure, as it misinterprets the scope of coverage intended by the policy and the regulatory expectations for fair claims settlement. Professionals should adopt a systematic and evidence-based decision-making process. This involves 1. Thoroughly reviewing the policy wording, paying close attention to definitions of gross profit, revenue, and any specific exclusions or inclusions related to expenses. 2. Obtaining detailed financial records from the insured, including profit and loss statements, balance sheets, and supporting documentation for all expenses incurred during the indemnity period and the period immediately preceding the loss. 3. Analyzing each expense item individually, considering its nature and whether it would have continued or ceased had the interruption not occurred, referencing industry norms and accounting standards where appropriate. 4. Documenting the rationale for each classification, providing clear justification for why an expense is deemed fixed or variable, and cross-referencing this with policy terms and regulatory guidance. 5. Engaging in open communication with the insured to explain the classification process and address any queries or concerns. Question 7. The monitoring system demonstrates that a business experienced a significant interruption to its operations. To assess the business interruption claim, the insurer needs to determine the cost of goods sold (COGS) for the indemnity period. Which of the following approaches best reflects the regulatory and accounting principles for calculating COGS in this context? Option A. Estimate COGS by multiplying the gross profit margin from the last financial year by the sales revenue achieved during the indemnity period. Option B. Include all operating expenses, such as rent, salaries, and marketing costs, in the COGS calculation for the indemnity period. Option C. Determine COGS by identifying all direct costs associated with the production or acquisition of goods that were sold or would have been sold during the indemnity period, adjusted for any changes in inventory levels during that period. Option D. Calculate COGS by taking the average COGS from the 2 financial years preceding the interruption and applying it to the indemnity period. The correct answer is D. Calculate COGS by taking the average COGS from the 2 financial years preceding the interruption and applying it to the indemnity period. Explanation: this scenario is professionally challenging because accurately calculating the cost of goods sold (COGS) for business interruption insurance claims requires a nuanced understanding of accounting principles and the specific policy wording, especially when dealing with fluctuating inventory values and the impact of the interruption. The insurer and the insured may have differing interpretations of what constitutes a direct cost of goods sold during the indemnity period. Careful judgment is required to ensure the calculation is both fair to the insured and compliant with the policy and relevant accounting standards. The correct approach involves a meticulous review of the business's accounting records to identify all direct costs attributable to the production or acquisition of goods sold during the period immediately preceding the interruption, and then adjusting this figure for any changes in inventory levels during the indemnity period. This method aligns with standard accounting practices for COGS and ensures that the claim reflects the actual loss of profit on goods that would have been sold had the interruption not occurred. Regulatory frameworks, such as those governing insurance claims in the UK, emphasize fairness and accuracy in loss assessment, requiring that calculations are based on verifiable financial data and adhere to generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS, as applicable. An incorrect approach would be to simply use the COGS figure from the last financial year without any adjustment for the indemnity period. This fails to account for the actual trading activity during the period of loss and could significantly understate or overstate the claim, leading to potential disputes and a breach of the insurer's duty of good faith. Another incorrect approach is to include indirect overheads or expenses not directly tied to the production or purchase of goods sold. This deviates from the definition of COGS and inflates the claim beyond what is recoverable under a business interruption policy, potentially violating principles of indemnity and good faith. A further incorrect approach might be to estimate COGS based on sales figures alone, without a proper accounting basis for the cost component. This lacks the necessary substantiation and can lead to an inaccurate and unsupportable claim. Professionals should adopt a systematic decision-making process. First, thoroughly understand the policy wording regarding business interruption and COGS. Second, gather all relevant financial documentation, including purchase invoices, production cost records, and inventory records. Third, apply appropriate accounting principles to calculate COGS for the period immediately preceding the loss, and then adjust for inventory changes during the indemnity period. Fourth, clearly document the methodology and calculations, providing clear justification for each component. Finally, engage in open communication with the insured and insurer to ensure transparency and agreement on the calculation. Question 8. Cost-benefit analysis shows that while a simplified approach to calculating gross profit for a business interruption claim might seem efficient, it carries significant risks. Considering the regulatory framework for business interruption insurance certificates, which of the following best reflects the appropriate application of the gross profit method when faced with an implementation challenge? Option A. Focus on the policy's specific definition of gross profit, ensuring all continuing expenses that would have been incurred but for the interruption are included, and then determine a reasonable indemnity period based on the business's likely recovery time. Option B. Use the most recent year's net profit as the sole basis for the gross profit calculation, as this represents the business's profitability. Option C. Exclude all standing charges from the gross profit calculation to simplify the process and expedite the claim settlement. Option D. Assume a standard indemnity period of 6 months, as this is a common duration for many business interruptions. Correct answer is A. Focus on the policy's specific definition of gross profit, ensuring all continuing expenses that would have been incurred but for the interruption are included, and then determine a reasonable indemnity period based on the business's likely recovery time. Explanation. This scenario presents a professional challenge because accurately applying the gross profit method for business interruption insurance claims requires a nuanced understanding of the policy wording and the business's operational realities, rather than a purely mechanical calculation. The challenge lies in interpreting what constitutes gross profit, as defined by the policy, and ensuring that the indemnity period accurately reflects the time needed for the business to return to its pre-loss trading position, considering all relevant factors. Careful judgment is required to avoid underinsuring or overinsuring, which can lead to disputes and financial hardship for the policyholder. The correct approach involves a thorough review of the business's financial records and the specific wording of the business interruption insurance policy to determine the definition of gross profit. This typically includes net profit plus all other standing charges and expenses that would continue to be incurred during the interruption period, regardless of the turnover. The application of this method should then focus on estimating the likely gross profit the business would have earned had the interruption not occurred, and crucially, determining the indemnity period that reasonably allows the business to resume its normal operations. This aligns with the fundamental principle of indemnity in insurance, which aims to restore the policyholder to the financial position they would have been in had the loss not occurred, as stipulated by general insurance law and specific regulatory guidance on claims handling. An incorrect approach would be to solely rely on historical net profit figures without considering the policy's definition of gross profit. This fails to account for standing charges that continue during an interruption and would have been covered under the policy, leading to an inaccurate assessment of the loss. This contravenes the principle of indemnity and potentially breaches regulatory requirements for fair claims handling. Another incorrect approach would be to arbitrarily set an indemnity period without a reasoned assessment of the business's recovery time. This might involve underestimating the time required to repair damage, source new suppliers, or re-establish customer relationships. Such an approach neglects the insurer's duty to indemnify for the full duration of the loss and may violate regulatory expectations for thorough claims investigation. A further incorrect approach would be to include expenses that would have ceased during the interruption, even if they are typically considered standing charges. For example, if a specific standing charge was demonstrably eliminated by the business prior to the loss, its inclusion in the gross profit calculation would be erroneous. This misapplication of the gross profit definition distorts the indemnity calculation and is inconsistent with the policy's intent. Professionals should adopt a decision-making framework that prioritizes a comprehensive understanding of the policy terms and the specific circumstances of the insured business. This involves engaging with the policyholder to gather all necessary financial information, critically assessing the definition of gross profit within the policy document, and making a reasoned judgment on the appropriate indemnity period based on evidence of the business's recovery trajectory. Adherence to regulatory codes of conduct for claims handling, which emphasize fairness, transparency, and promptness, is paramount. Question 9. What factors determine the extent to which an insurer can exercise subrogation rights against a third party following a business interruption claim under a UK-regulated business interruption insurance certificate? Option A. The specific wording of the subrogation clause in the insurance policy, the actions of the insured in relation to the loss and any potential recovery from a third party, and the insurer's conduct in handling the claim. Option B. The length of time that has passed since the business interruption event occurred. Option C. The insurer's desire to recoup the full amount of the claim payout, regardless of policy limitations or insured's actions. Option D. The perceived financial standing of the third party and the ease with which recovery can be achieved. The correct answer is A. The specific wording of the subrogation clause in the insurance policy, the actions of the insured in relation to the loss and any potential recovery from a third party, and the insurer's conduct in handling the claim. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of subrogation rights within the specific regulatory framework governing business interruption insurance certificates. Likely in the UK given the SISI context. The insurer's right to subrogate is not absolute and is heavily influenced by policy wording, the actions of the insured, and relevant legal principles designed to prevent double recovery and ensure fairness. A careful judgment is required to balance the insurer's right to recover losses with the insured's obligations and the potential impact on their ongoing business relationship. The correct approach involves a thorough assessment of the policy wording to identify any clauses that might limit or waive subrogation rights, particularly in situations where the insured has acted in good faith or where pursuing subrogation could unduly prejudice their business. It also necessitates understanding the insured's actions leading up to and following the loss to determine if they have inadvertently or intentionally compromised the insurer's subrogation prospects. This approach is correct because it aligns with the principle of indemnity, ensuring the insured is compensated for their loss without being unjustly enriched, while also respecting contractual obligations and the spirit of the insurance contract. Regulatory guidance, such as that provided by the Financial Conduct Authority, FCA in the UK, emphasizes fair treatment of customers, which includes not pursuing subrogation in a manner that is oppressive or unfair to the policyholder. An incorrect approach would be to automatically assume full subrogation rights without a detailed review of the policy and the circumstances. This fails to acknowledge that subrogation is an equitable right that can be modified by contract or waived by the insurer's conduct. It also overlooks the potential for the insured to have taken reasonable steps to mitigate their loss or to have acted in a way that, while not intentionally compromising the insurer, might affect the insurer's ability to recover from a third party. Ethically, this approach could lead to disputes and damage the insurer-policyholder relationship, potentially breaching principles of good faith and fair dealing expected by regulators. Another incorrect approach is to abandon subrogation entirely based on a minor inconvenience or a perceived difficulty in recovery. This would be a failure to act in the best interests of the insurer and its stakeholders, as subrogation is a legitimate mechanism for recovering claims costs. It also fails to consider the insurer's responsibility to manage its financial exposure prudently. This approach could be seen as a dereliction of duty and a failure to adhere to the principles of sound insurance practice. The professional decision-making process for similar situations should involve a systematic risk assessment. This begins with a comprehensive review of the insurance policy, paying close attention to subrogation clauses and any endorsements or exclusions. Simultaneously, a detailed investigation into the cause of the loss and the actions of all parties involved, including the insured and any potential third party responsible, is crucial. Legal counsel should be consulted to interpret complex policy provisions and assess the strength of any potential subrogation claim. Throughout this process, maintaining open communication with the insured and adhering to regulatory requirements for fair treatment of customers are paramount. Question 10. Examination of the data shows that a financial institution offering business interruption insurance has experienced a significant security breach, potentially exposing sensitive policyholder information. The internal IT security team has identified the breach and is working to contain it, but has not yet fully quantified the extent of the data compromised or the specific individuals affected. Institution is considering delaying formal notification to the Information Commissioner's Office, ICO, and affected policyholders until the investigation is complete and all remediation steps are finalized to avoid causing undue alarm. Which of the following approaches best aligns with the regulatory framework and ethical obligations for financial institutions in the UK concerning data breaches and business interruption insurance policyholders? Option A. Provide a general public announcement about a potential security incident without naming specific affected individuals or the ICO to manage reputational risk. Option B. Notify the ICO only, as policyholder notification is secondary and can be addressed once the internal investigation is complete and the full scope of the breach is understood. Option C. Immediately initiate the notification process to the ICO and affected policyholders, providing the best available information at the time of notification, while continuing the investigation and providing updates as necessary. Option D. Delay all formal notifications to the ICO and policyholders until the internal investigation is fully concluded and all remediation actions are implemented to ensure complete and accurate information is provided. The correct answer is C. Immediately initiate the notification process to the ICO and affected policyholders, providing the best available information at the time of notification, while continuing the investigation and providing updates as necessary. Explanation: this scenario is professionally challenging because financial institutions operating under the UK regulatory framework, particularly those offering business interruption insurance, face stringent obligations regarding data security and customer notification following a breach. The complexity arises from balancing the need for swift action to contain a breach with the legal and ethical imperatives to inform affected policyholders and regulators in a timely and accurate manner, all while adhering to specific reporting timelines and content requirements. Careful judgment is required to interpret the scope of the breach, identify affected individuals, and determine the appropriate level of disclosure without causing undue panic or compromising ongoing investigations. The correct approach involves a systematic and compliant response that prioritizes regulatory adherence and customer protection. This entails immediately assessing the nature and extent of the security breach, identifying all affected policyholders, and initiating the mandatory notification process to the Information Commissioner's Office (ICO) and affected individuals as stipulated by the UK GDPR and the Financial Conduct Authority (FCA) regulations. This approach is correct because it directly addresses the legal obligations under the UK GDPR, which mandates notification of personal data breaches to the ICO without undue delay, and where the breach is likely to result in a high risk to the rights and freedoms of individuals. Notification to those individuals is also required. The FCA's principles for businesses, particularly Principle 11, Relations with Regulators, also necessitates informing the FCA of any matter which a reasonable firm would expect to have a material effect on the firm. Prompt and transparent communication with policyholders is ethically sound and crucial for maintaining trust and allowing them to take protective measures. An incorrect approach that focuses solely on internal remediation without immediate regulatory notification fails to meet the legal requirements of the UK GDPR and the FCA. This oversight constitutes a significant regulatory failure, as it breaches the duty to report data breaches promptly. Another incorrect approach that delays notification to policyholders until all investigative aspects are fully resolved, even if the breach is confirmed and impacts are understood, risks exceeding the stipulated timelines for notification and can be seen as a failure to act in the best interests of the customer, potentially leading to further harm and regulatory sanctions. A third incorrect approach that provides vague or incomplete information to the ICO and policyholders, or attempts to downplay the severity of the breach, is ethically unsound and violates the principles of transparency and accountability mandated by both data protection laws and FCA conduct rules. Professionals should adopt a decision-making framework that begins with a clear understanding of the relevant regulatory landscape, UK GDPR, FCA Handbook. Upon detection of a potential breach, the immediate steps should be to contain the incident, assess its impact, and determine if it constitutes a notifiable personal data breach. This assessment should be conducted swiftly, involving relevant internal teams, legal, IT security, compliance, and potentially external forensic experts. A predefined incident response plan, which includes clear escalation procedures and communication protocols, is essential. The decision to notify and the content of that notification must be guided by the specific criteria outlined in the UK GDPR and FCA guidance, ensuring accuracy, completeness, and timeliness. Continuous monitoring and communication with regulators and affected parties throughout the incident resolution process are also critical components of responsible professional conduct. Question 11. When evaluating a business interruption insurance claim following a widespread power outage that impacted multiple businesses in a region, what is the most appropriate regulatory compliant approach for a certificate holder to determine if the policy's period of interruption has commenced? Option A. Calculating the period of interruption based on the average duration of similar power outages experienced in the region over the past 5 years to ensure consistency in claims handling. Option B. Assuming the period of interruption begins on the date the regional power outage was first reported by local news outlets, as this indicates a significant disruption affecting the area. Option C. Ascertaining if the policy's definition of damage or interruption has been met by the power outage, and if so, identifying the date and time the insured business was directly affected and unable to resume operations as a result of that specific event. Option D, relying on the insured's verbal statement that their business was unable to operate due to the power outage, without verifying the specific policy trigger or the direct impact on their operations. The correct answer is C, ascertaining if the policy's definition of damage or interruption has been met by the power outage, and if so, identifying the date and time the insured business was directly affected and unable to resume operations as a result of that specific event. Explanation: scenario analysis. This scenario is professionally challenging because it requires the certificate holder to interpret and apply specific clauses within a business interruption insurance policy in the context of a real-world event. The challenge lies in accurately identifying the trigger for coverage and the extent of the indemnity period, ensuring compliance with the policy's terms and conditions, while also adhering to regulatory expectations for fair claims handling. Misinterpretation can lead to underpayment or denial of valid claims, resulting in financial hardship for the insured and potential regulatory sanctions for the insurer. Correct approach analysis. The correct approach involves a meticulous review of the policy wording, specifically focusing on the definition of interruption or damage and the conditions precedent to a claim. This approach is right because it directly addresses the contractual obligations between the insurer and the insured, which are the foundation of the insurance contract. Regulatory frameworks, such as those governing insurance claims handling, mandate that insurers act in good faith and deal with claims fairly, which necessitates a thorough and accurate interpretation of the policy terms. Adhering strictly to the policy's defined triggers and indemnity periods ensures that the claim is processed in accordance with the agreed-upon coverage, thereby fulfilling regulatory requirements for fair treatment of policyholders. Incorrect approaches analysis. One incorrect approach involves immediately assuming coverage based on the general disruption caused by the event, without a detailed examination of the policy's specific trigger for business interruption. This fails to acknowledge that business interruption insurance is not a general disruption policy, but is tied to specific perils and their consequences as defined in the contract. This approach risks overpromising coverage and can lead to disputes and regulatory complaints for misrepresentation or unfair claims handling. Another incorrect approach is to rely solely on industry common practice or anecdotal evidence regarding similar events without consulting the specific policy wording. While industry knowledge is valuable, it cannot override the explicit terms and conditions of an individual insurance contract. This approach is ethically and regulatorily flawed as it deviates from the contractual agreement and can result in claims being settled incorrectly, potentially to the detriment of either the insured or the insurer, and failing to meet the regulatory standard of treating customers fairly. A third incorrect approach is to interpret the policy in a manner that is overly restrictive or overly generous, without a balanced and objective assessment of the policy wording and the factual circumstances. This can arise from a desire to minimize payouts or to expedite the claims process without due diligence. Such an approach undermines the principle of utmost good faith inherent in insurance contracts and can lead to regulatory scrutiny for unfair claims practices. Professional reasoning. Professionals should adopt a systematic approach to claims assessment. This involves 1. Thoroughly understanding the insured's business operations and the nature of the disruption. 2. Meticulously reviewing the specific policy wording, paying close attention to definitions, ensuring clauses, exclusions, and conditions. 3. Gathering all relevant evidence to establish the cause and effect of the loss. 4. Applying the policy terms objectively to the facts, ensuring compliance with all applicable regulatory requirements for claims handling. This structured process ensures fairness, accuracy, and adherence to both contractual and regulatory obligations. Question 12. Strategic planning requires a business to consider various risk management strategies to mitigate the impact of potential business interruptions. Which of the following approaches best aligns with the principles of proactive risk management and regulatory expectations for business resilience? Option A. Implementing significant cost-cutting measures across all operational areas to reduce overheads, even if it impacts redundancy and emergency preparedness. Option B. Relying solely on the insurance payout to cover all financial losses incurred during a period of business interruption. Option C. Ensuring the business interruption insurance policy has a sufficiently high indemnity period to cover all potential losses. Option D. Developing a comprehensive business continuity plan that identifies critical operational dependencies, outlines alternative operational procedures, and includes regular testing and review. The correct answer is D. Developing a comprehensive business continuity plan that identifies critical operational dependencies, outlines alternative operational procedures, and includes regular testing and review. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how to proactively mitigate the financial impact of business interruption, moving beyond mere reactive insurance claims. The challenge lies in identifying and implementing strategies that are not only effective, but also compliant with the principles of prudent risk management, as expected within the regulatory framework governing business interruption insurance. Careful judgment is required to balance the cost of mitigation with the potential severity and likelihood of interruption events. The correct approach represents best professional practice because it directly addresses the core objective of business interruption insurance, to restore the business to its pre-loss financial position. By focusing on business continuity planning, including identifying critical dependencies and developing alternative operational strategies, a business is better equipped to minimize the duration and financial impact of an interruption. This proactive stance aligns with the spirit of risk management and the regulatory expectation that businesses take reasonable steps to protect their assets and operational capacity. Such planning demonstrates due diligence and a commitment to resilience, which are implicitly encouraged by regulatory bodies overseeing insurance and financial stability. An approach that solely relies on the adequacy of the insurance policy without considering internal mitigation measures is professionally unacceptable. This fails to acknowledge that insurance is a financial backstop, not a substitute for operational resilience. While the policy provides financial compensation, it does not prevent the disruption itself or the associated non-insurable losses like reputational damage or loss of market share due to prolonged downtime. This approach risks underestimating the business's vulnerability and may lead to a greater overall loss than anticipated, even with a valid claim. Another incorrect approach is to prioritize cost-cutting over risk mitigation, such as reducing investment in redundant systems or emergency preparedness. This is ethically questionable and potentially breaches regulatory expectations for prudent financial management and risk assessment. Such actions increase the likelihood and severity of business interruption, directly contradicting the purpose of risk management strategies. It demonstrates a short-sighted view that prioritizes immediate savings over long-term business viability and resilience. Finally, an approach that neglects to regularly review and update risk assessments and business continuity plans is also professionally deficient. The business environment is dynamic, with new threats emerging and existing ones evolving. Failure to adapt plans to current realities means that the mitigation strategies may become obsolete, leaving the business exposed. Regulatory frameworks often imply a need for ongoing vigilance and adaptation in risk management practices. Professionals should adopt a decision-making framework that begins with a comprehensive risk assessment, identifying potential causes of business interruption and their likely impact. This should be followed by the development and implementation of a layered risk management strategy, incorporating both preventative measures and robust business continuity plans. Regular review and testing of these plans, alongside an appropriate insurance program, form the cornerstone of effective business interruption risk management. Question 13. Stakeholder feedback indicates that clients insured under a business interruption policy with extra expense coverage are increasingly seeking reimbursement for costs incurred to maintain operations at a reduced capacity during a period of partial disruption, even when there is no complete cessation of business. One client, a retail store, has incurred significant costs for temporary staffing and additional marketing efforts to mitigate the impact of a localized utility outage that has reduced foot traffic but not halted sales entirely. The client believes these costs are a direct result of the covered peril and should be covered under their extra expense provision. As an insurance professional advising this client, how should you approach this situation, considering the scope and limitations of extra expense coverage under typical UK regulatory frameworks for business interruption insurance? Option A. Advise the client that extra expense coverage is designed to cover costs incurred to resume or continue operations at the premises following a covered loss, and that a detailed review of the policy wording, is necessary to determine if these specific costs for temporary staffing and marketing fall within the definition of necessary expenses to resume or continue operations, considering the limitations on coverage for partial disruptions. Option B. Suggest the client explore alternative insurance policies or government grants for these types of operational mitigation expenses, as extra expense coverage is not intended for such situations. Option C. Immediately approve the client's claim for temporary staffing and marketing costs, as the client has incurred expenses to mitigate the business interruption and maintain some level of sales, demonstrating a good faith effort to continue operation. Option D. Inform the client that extra expense coverage only applies when the business is completely shut down, and that any costs incurred during a partial disruption are not covered, regardless of the policy wording. Correct answer is A. Advise the client that extra expense coverage is designed to cover costs incurred to resume or continue operations at the premises following a covered loss, and that a detailed review of the policy wording is necessary to determine if these specific costs for temporary staffing and marketing fall within the definition of necessary expenses to resume or continue operations, considering the limitations on coverage for partial disruption. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance the client's immediate desire for a broad interpretation of coverage with the insurer's contractual obligations and the regulatory framework governing business interruption insurance. The core of the dilemma lies in interpreting the scope and limitations of extra expense coverage, particularly when the business is not fully shut down, but is experiencing significant operational disruption. The professional must exercise careful judgment to avoid misrepresenting coverage, which could lead to regulatory sanctions and damage to the professional relationship. The correct approach involves a thorough review of the policy wording, specifically the definitions and exclusions related to extra expense coverage, and a clear communication of these terms to the client. This approach is right because it adheres strictly to the contractual agreement between the insured and the insurer, which is the foundation of insurance law and regulation. By accurately explaining what the policy covers and its limitations, the professional upholds their duty of care to the client and complies with regulatory requirements that mandate fair and transparent dealings. This aligns with the principles of good faith and fair dealing expected of insurance professionals. An incorrect approach would be to unilaterally agree to cover expenses not explicitly contemplated by the extra expense clause, based solely on the client's assertion of need. This fails to respect the contractual limitations of the policy. Ethically, it misrepresents the coverage available and could lead to the client incurring expenses with the expectation of reimbursement that the insurer is not obligated to provide. This also violates regulatory principles of accurate representation of policy terms. Another incorrect approach would be to dismiss the client's concerns outright without a detailed review of the policy and the specific circumstances. While adhering to policy terms is crucial, a complete disregard for the client's operational challenges and their impact on extra expenses can be seen as a failure in customer service and potentially a breach of the duty of care to advise the client appropriately on their coverage. This can lead to client dissatisfaction and potential complaints to regulatory bodies. The professional decision-making process for similar situations should involve 1. Actively listening to and understanding the client's concerns and operational impact. 2. Conducting a meticulous review of the relevant policy provisions, including definitions, coverage grants, limitations, and exclusions for extra expense. 3. Consulting with the insurer's claims department or underwriting team if there is ambiguity in the policy wording or its application to the specific circumstances. 4. Clearly and transparently communicating the findings to the client, explaining the policy's coverage and limitations in plain language, and documenting all advice given. 5. If the client's requested expenses fall outside the policy's scope, exploring alternative solutions, or advising the client on potential out-of-pocket costs. Question 14. Regulatory review indicates that a business interruption insurance claim has been lodged following a fire that halted operations. The insurer is reviewing the insured's operating expenses to determine the indemnity period. Which approach to classifying these expenses best aligns with the principles of business interruption insurance and regulatory expectations for fair claims handling? Option A. Classify only those expenses that remained at their pre-interruption level without any reduction. Option B. Classify only those expenses explicitly listed as continuing in the insurance policy wording. Option C. Classify all expenses that would have been incurred by the business had the interruption not occurred, based on a review of the insured's financial records and the policy wording. Option D. Classify all expenses listed on the insured's profit and loss statement as continuing expenses. The correct answer is C. Classify all expenses that would have been incurred by the business had the interruption not occurred, based on a review of the insured's financial records and the policy wording. Explanation. This scenario is professionally challenging because accurately classifying operating expenses for business interruption insurance claims requires a nuanced understanding of both accounting principles and the specific policy wording. The insurer must determine which expenses would have continued to be incurred by the insured business had the interruption not occurred, and which would have ceased. This distinction is critical for calculating the indemnity period and the quantum of loss, directly impacting the payout. Misclassification can lead to underpayment, causing financial hardship for the insured, or overpayment, resulting in an unjustified financial burden on the insurer. Careful judgment is required to balance the insured's need for full recovery with the insurer's obligation to pay only for covered losses as defined by the policy and regulatory guidelines. The correct approach involves meticulously reviewing the insured's financial records and the business interruption policy to identify expenses that are continuing in nature. This means expenses that the business would have been legally or contractually obligated to pay regardless of whether operations were ongoing or had ceased due to the insured peril. Examples often include rent, salaries of essential personnel, loan repayments, and insurance premiums. This approach is correct because it directly aligns with the fundamental principle of business interruption insurance, which aims to restore the insured to the financial position they would have been in had the loss not occurred, by covering those expenses that would have continued. Regulatory frameworks, such as those governing insurance claims handling, mandate fair and accurate assessment of losses, and this method ensures that only legitimate continuing expenses are considered, thereby fulfilling the policy's promise and regulatory obligations. An incorrect approach would be to broadly categorize all expenses listed on the profit and loss statement as continuing expenses. This fails to distinguish between expenses that cease with operations, like raw materials, direct labor tied to production, or sales commissions, and those that persist. This approach is ethically and regulatorily flawed because it would likely lead to an inflated claim, exceeding the actual financial impact of the interruption, and violating the principle of indemnity. Another incorrect approach would be to only consider expenses that are explicitly listed as continuing in the policy wording, ignoring other expenses that are clearly continuing in nature based on standard accounting practices and the nature of the business. This is incorrect because policy wordings, while important, may not be exhaustive, and the intent of business interruption insurance is to cover the actual continuing expenses that would have been incurred. A rigid adherence to an incomplete list without considering the economic reality of the business's obligations would be a failure to act in good faith and could contravene regulatory expectations for fair claims handling. A further incorrect approach would be to exclude any expense that has been reduced in any way during the interruption period, even if a significant portion remains. This is incorrect because the definition of a continuing expense is one that would have continued to be incurred, not necessarily one that would have been incurred at the exact same level. For example, while some salaries might be reduced due to overtime not being worked, the base salary often remains a continuing expense. This approach would unfairly penalize the insured by not recognizing the actual continuing financial obligations. Professionals should employ a decision-making framework that begins with a thorough understanding of the policy's definition of continuing expenses and the insured's business operations. This involves a detailed examination of the insured's accounting records, supported by evidence of contractual or legal obligations. The process should involve open communication with the insured to gather necessary documentation and clarify any ambiguities. The assessment should be objective, adhering to both the policy terms and relevant regulatory guidelines for claims settlement, ensuring fairness and accuracy in the calculation of the business interruption loss. Question 15. The evaluation methodology shows that when determining appropriate policy limits and deductibles for business interruption insurance, which of the following represents the most prudent and compliant approach for ensuring adequate coverage without creating undue financial burden on the insured or insurer. Option A. Prioritizing the lowest possible premium by setting minimal policy limits and the highest feasible deductibles, regardless of the business's specific financial exposure. Option B. Setting policy limits based on the maximum potential loss scenario, even if it significantly exceeds the business's likely financial recovery needs, and imposing a high deductible to offset the increased limit. Option C. A comprehensive assessment of the business's gross profit, ongoing expenses, and estimated indemnity period, with limits and deductibles collaboratively agreed upon based on these factors and the insured's risk tolerance. Option D. Relying on generic industry benchmarks for policy limits and deductibles, without a detailed analysis of the individual business's financial structure or operational risks. The correct answer is C. A comprehensive assessment of the business's gross profit, ongoing expenses, and estimated indemnity period, with limits and deductibles collaboratively agreed upon based on these factors and the insured's risk tolerance. Explanation. The evaluation methodology shows that setting appropriate policy limits and deductibles for business interruption by insurance is a complex process requiring careful judgment. The professional challenge lies in balancing the insured's need for adequate coverage against the insurer's risk exposure and the practicalities of underwriting. Overinsuring can lead to inflated premiums for the policyholder and potential issues with indemnity principles, while underinsuring leaves the business vulnerable to significant financial losses that the policy was intended to mitigate. Deductibles, while reducing premium costs, must be set at a level that the insured can reasonably absorb without jeopardizing their financial stability during a claim. This scenario demands a thorough understanding of the business's operations, potential loss scenarios, and the regulatory environment governing insurance contracts. The correct approach involves a comprehensive assessment of the business's gross profit or revenue, considering all ongoing expenses that would continue during a period of interruption. This includes fixed costs and any other expenses that are not directly related to the volume of sales or production. The indemnity period, representing the time required for the business to resume its normal operations, must also be realistically estimated. Policy limits should be aligned with these projected financial impacts, ensuring that the coverage is sufficient to restore the business to its pre-loss financial position. Deductibles should be determined in consultation with the insured, considering their risk appetite and financial capacity to withstand a certain level of loss. This approach aligns with the fundamental principle of indemnity in insurance, aiming to place the insured back in the financial position they were in before the loss, without profiting from the claim. It also adheres to regulatory requirements that mandate fair and transparent policy terms and conditions, ensuring that coverage is not misleading or inadequate. An approach that focuses solely on the lowest possible premium without a thorough assessment of the business's financial exposure is professionally unacceptable. This failure to adequately assess risk and potential loss can lead to underinsurance, violating the principle of indemnity and potentially breaching regulatory obligations to provide suitable advice and coverage. Another incorrect approach is to set policy limits based on arbitrary figures or industry averages without specific regard to the individual business's unique circumstances and financial structure. This can result in coverage that is either insufficient or excessive, failing to meet the regulatory expectation of providing a policy that is appropriate for the insured's needs. Furthermore, setting deductibles without considering the insured's financial capacity to absorb the deductible amount can expose the business to undue financial hardship during a claim. This demonstrates a lack of due diligence and can be seen as a failure to act in the best interests of the client, potentially contravening ethical guidelines and regulatory expectations for responsible insurance provision. Professionals should adopt a systematic decision-making process that begins with a detailed understanding of the insured's business operations, financial statements, and risk profile. This should be followed by a collaborative discussion with the insured to establish realistic expectations for coverage and deductible levels. The insurer's underwriting guidelines and regulatory requirements must then be applied to ensure that the proposed policy limits and deductibles are both appropriate for the insured and acceptable from an underwriting perspective. Regular reviews of the policy are also crucial to account for changes in the business's operations or financial performance. Question 16. Cost-benefit analysis shows that a thorough understanding of a client's financial statements is essential for accurately assessing business interruption insurance needs. When reviewing a client's financial reports to determine appropriate coverage, which approach best demonstrates a comprehensive understanding of the potential financial impact of an interruption? Option A. Analyzing only the income statement to quantify lost profits and ongoing expenses. Option B. Focusing exclusively on the balance sheet to assess the company's asset base and ability to cover liabilities during a shutdown. Option C. Examining only the cash flow statement to determine the business's immediate liquidity and ability to meet short-term obligations. Option D. Reviewing all three core financial statements, the income statement, balance sheet, and cash flow statement, to gain a holistic view of the business's financial health and operational vulnerabilities. The correct answer is A. Analyzing only the income statement to quantify lost profits and ongoing expenses. Explanation: this scenario is professionally challenging because it requires an insurance broker to interpret financial statements to assess the potential impact of business interruption on a client's operations, directly informing the adequacy of their insurance coverage. The broker must move beyond a superficial understanding of financial reports to a nuanced appreciation of how different statements reflect the business's financial health and its vulnerability to disruption. This requires careful judgment to ensure the advice provided is accurate, compliant with regulatory expectations for client advice, and ethically sound, preventing underinsurance or overinsurance. The correct approach involves a comprehensive review of the income statement, balance sheet, and cash flow statement to understand the client's revenue streams, cost structure, asset base, liabilities, and liquidity. Specifically, the income statement reveals the profitability and operational efficiency, highlighting the direct financial losses that would occur during an interruption. The balance sheet provides insight into the company's assets and liabilities, which can indicate its resilience and ability to withstand financial shocks. The cash flow statement is crucial for understanding the business's ability to generate and manage cash, a critical factor in surviving a period without revenue. By synthesizing information from all three statements, the broker can accurately estimate the potential business interruption loss and recommend appropriate coverage limits and indemnity periods, aligning with the regulatory duty to act in the client's best interest and provide suitable advice. An incorrect approach that focuses solely on the income statement fails to consider the business's underlying financial stability and its ability to meet ongoing obligations during a shutdown. This could lead to underestimating the total financial impact, as it overlooks fixed costs that continue to accrue even when revenue stops, and the potential for asset liquidation to cover expenses. Such an approach risks recommending insufficient coverage. Another incorrect approach that prioritizes only the balance sheet neglects the dynamic nature of business operations and the direct loss of profit that is the core of business interruption insurance. While assets and liabilities are important for solvency, they do not directly quantify the loss of earnings during a period of closure. This oversight can lead to a miscalculation of the required indemnity period and coverage amount. A third incorrect approach that concentrates exclusively on the cash flow statement, while important for liquidity, may not fully capture the total potential loss of profit. The cash flow statement primarily tracks the movement of cash, and while it can indicate short-term survival, it might not reflect the full extent of lost revenue and profit that would be covered by business interruption insurance. This can result in inadequate coverage for the actual business interruption loss. Professionals should adopt a holistic approach to financial statement analysis. This involves understanding the interrelationships between the income statement, balance sheet, and cash flow statement. The decision-making process should begin with identifying the client's core business operations and potential interruption scenarios. Then, systematically analyze each financial statement to quantify the potential financial impact of these scenarios, considering both direct losses, lost profits, and indirect costs, ongoing expenses. Finally, use this comprehensive understanding to recommend insurance coverage that adequately protects the client's financial interests, ensuring compliance with regulatory requirements for suitability and client care. Question 17. Cost-benefit analysis shows that while a detailed examination of accounting standards can be time-consuming, failing to do so can lead to significant under- or oversettlement of business interruption claims. In the context of a claim following a fire at a manufacturing facility, which approach best aligns with the principles of indemnity and regulatory expectations for claims handling concerning the treatment of depreciation and the capitalization of repairs to damaged machinery. Option A. Exclude depreciation from the calculation of gross profit lost, as it is a non-cash expense, and treat all repair costs as direct expenses to be recovered. Option B. Include depreciation in the calculation of gross profit lost, as it represents a cost of using assets, and capitalize the repair costs as improvements to the machinery. Option C. Include depreciation in the calculation of gross profit lost, as it represents a cost of using assets, and treat the repair costs as direct expenses to be recovered. Option D. Exclude depreciation from the calculation of gross profit lost, as it is a non-cash expense, and treat the repair costs as direct expenses to be recovered, reflecting the cost of restoring the machinery to its pre-loss condition. Correct answer is A. Exclude depreciation from the calculation of gross profit lost, as it is a non-cash expense, and treat all repair costs as direct expenses to be recovered. Explanation. This scenario presents a professional challenge because the application of accounting standards, specifically the treatment of certain expenses and revenue recognition, can significantly impact the quantum of a business interruption claim. Insurers and policyholders may have differing interpretations of how these standards should be applied in the context of a loss, leading to disputes. The challenge lies in navigating these accounting complexities while adhering to the principles of indemnity and the specific terms of the business interruption policy, all within the regulatory framework governing insurance claims. Careful judgment is required to ensure the claim accurately reflects the financial impact of the interruption without over or under-indemnifying the policyholder. The correct approach involves a meticulous review of the policy wording and the relevant accounting standards, e.g., FRS 102 in the UK, or relevant US GAAP if specified for the exam jurisdiction, to determine how specific items should be treated. This approach prioritizes the principle of indemnity, aiming to restore the policyholder to the financial position they would have been in had the loss not occurred. It requires understanding how accounting standards dictate the recognition of revenue, the capitalization or expensing of certain costs, and the valuation of inventory. For instance, if the policy covers gross profit, understanding how accounting standards define revenue and cost of sales is crucial. Adherence to these principles ensures that the claim is fair, compliant with the policy, and aligns with regulatory expectations for claims handling, which often emphasize fairness and prompt settlement. An incorrect approach would be to disregard the impact of accounting standards and rely solely on a simplified view of financial statements. This failure to engage with the nuances of accounting treatment can lead to miscalculations of the indemnity period or the gross profit lost. For example, if accounting standards require certain costs to be capitalized rather than expensed, and the insurer or policyholder treats them as direct expenses in the claim calculation, it would misrepresent the true financial impact and violate the principle of indemnity. Another incorrect approach is to selectively apply accounting principles to inflate the claim. This is ethically unsound and breaches regulatory requirements for honest and fair claims handling. Such actions can lead to regulatory sanctions and damage the reputation of the professional. The professional decision-making process should involve a thorough understanding of the policy's insuring clauses and definitions, particularly those related to business interruption and the basis of settlement, e.g., gross profit, net profit. This should be followed by a detailed analysis of the policyholder's financial records, cross-referenced with the applicable accounting standards. Where discrepancies or ambiguities arise, professionals should seek clarification from the policyholder and, if necessary, consult with accounting experts. The ultimate goal is to arrive at claim settlement that is both compliant with the policy and the law, and ethically sound, reflecting the true financial consequences of the interruption. Question 18. Research into the application of business interruption insurance certificate principles reveals a scenario where a manufacturing firm experiences a significant drop in revenue following a fire that damaged its primary production facility. The policy covers business interruption. The firm also notes a decline in orders from a major client who, independently, is facing financial difficulties and has reduced its overall purchasing. Which of the following best distinguishes between direct and indirect losses in this context, according to standard insurance principles and regulatory expectations for claims handling? Option A. The loss of net profit is a direct loss, but the increased costs incurred to expedite future production once the facility is repaired are also considered direct losses. Option B. The entire decline in revenue, regardless of its cause, is considered a direct loss because it occurred during the period of business interruption. Option C. The reduction in orders from the major client is a direct loss because it is a consequence of the overall disruption to the business's supply chain. Option D. The loss of net profit directly resulting from the inability to produce goods due to the fire is a direct loss, while the reduction in orders from the financially struggling client, even if exacerbated by the production halt, is an indirect loss. The correct answer is D. The loss of net profit directly resulting from the inability to produce goods due to the fire is a direct loss, while the reduction in orders from the financially struggling client, even if exacerbated by the production halt, is an indirect loss. Explanation: this scenario is professionally challenging because accurately distinguishing between direct and indirect losses in a business interruption claim requires a nuanced understanding of policy wording and the causal link between the insured peril and the resulting financial impact. Misclassification can lead to underpayment or overpayment of claims, impacting both the insured's recovery and the insurer's financial stability, and potentially breaching regulatory obligations related to fair claims handling. The correct approach involves meticulously examining the policy's definition of business interruption and the scope of coverage for consequential losses. It requires tracing the financial impact directly back to the interruption caused by the insured peril. For instance, if a fire, insured peril, forces a business to close, the loss of net profit and increased costs to mitigate the loss, e.g., renting temporary premises, are direct losses. This aligns with the regulatory framework's emphasis on indemnifying the insured for losses directly flowing from the insured event, as stipulated by principles of indemnity and good faith in insurance contracts. An incorrect approach would be to broadly interpret the policy to include all financial downturns experienced by the business during a period of disruption, even if those downturns are not directly attributable to the insured peril. For example, including losses due to a pre-existing market downturn that coincidentally occurred during the interruption period would be an incorrect classification. This fails to adhere to the principle of proximate cause, which is fundamental to insurance law and regulatory guidance on claims settlement. Another incorrect approach is to conflate operational disruptions with financial losses. While operational disruption is the trigger, the claim is for the financial consequences of that disruption, not the disruption itself. Failing to differentiate between the physical or operational impact and the subsequent financial impact constitutes a misinterpretation of the policy's intent and regulatory expectations for claims assessment. Professionals should adopt a systematic claims assessment process. This involves 1. Thoroughly reviewing the policy wording, paying close attention to definitions of business interruption, covered perils and exclusions. 2. Investigating the cause of the interruption and its direct impact on the business's operations. 3. Quantifying the financial losses that are a direct and foreseeable consequence of the insured peril. 4. Differentiating these direct losses from indirect or consequential losses that fall outside the policy scope or are not causally linked to the insured event. 5. Documenting the rationale for classifying each loss component, ensuring transparency and compliance with regulatory requirements for claims handling. Question 19. To address the challenge of a policyholder experiencing significant business interruption due to a covered event, what is the most appropriate strategy for an insurer regarding interim payments and loss mitigation? Option A. Offer a substantial interim payment based on a preliminary assessment of loss and actively collaborate with the policyholder to identify and implement loss mitigation strategies. Option B. Provide a minimal interim payment that covers only immediate essential expenses, leaving the policyholder solely responsible for all loss mitigation efforts. Option C. Delay all interim payments until a comprehensive and final assessment of the total loss has been completed to ensure absolute accuracy. Option D. Issue a generous interim payment without discussing or agreeing upon specific loss mitigation strategies, allowing the policyholder to manage recovery independently. The correct answer is A. Offer a substantial interim payment based on a preliminary assessment of loss and actively collaborate with the policyholder to identify and implement loss mitigation strategies. Explanation: This scenario presents a professional challenge because the insurer must balance the immediate need to support the policyholder's recovery with the contractual obligations and regulatory requirements governing business interruption claims. The insurer's actions directly impact the policyholder's ability to resume operations, which in turn affects the final claim valuation. A failure to act promptly and appropriately can lead to financial hardship for the policyholder and potential regulatory scrutiny for the insurer. Careful judgment is required to ensure that interim payments are both sufficient to mitigate further loss and consistent with the policy terms and applicable regulations. The correct approach involves proactively offering a substantial interim payment based on a reasonable assessment of the likely loss, while also actively engaging with the policyholder to identify and facilitate loss mitigation strategies. This approach is justified by the principles of good faith and fair dealing inherent in insurance contracts and often mandated by regulatory frameworks. Specifically, regulations typically require insurers to handle claims promptly and to assist policyholders in minimizing their losses. By offering a significant interim payment, the insurer demonstrates a commitment to supporting the policyholder's recovery and preventing the business interruption from escalating. Simultaneously, collaborating on loss mitigation strategies ensures that the policyholder takes reasonable steps to reduce the overall impact of the interruption, aligning with the policy's intent to cover actual losses sustained. This proactive and collaborative stance minimizes the duration and severity of the business interruption, ultimately benefiting both parties. An incorrect approach would be to delay any interim payment until a final loss calculation is completed, citing the need for absolute certainty. This failure to provide timely financial support can exacerbate the policyholder's financial distress, potentially leading to permanent closure and greater overall loss. Ethically and regulatorily, this inaction can be seen as a breach of the duty of good faith and may violate regulations requiring prompt claims handling and assistance in loss mitigation. Another incorrect approach would be to offer a minimal interim payment that is insufficient to cover essential recovery costs, while simultaneously placing the onus entirely on the policyholder to implement all loss mitigation measures without insurer support or guidance. This approach fails to adequately assist the policyholder in their recovery efforts and may not align with the spirit of the business interruption coverage, which is intended to bridge the gap during operational disruption. Regulatory frameworks often expect insurers to play an active role in facilitating recovery, not merely to process claims passively. A third incorrect approach would be to make a substantial interim payment without any discussion or agreement on loss mitigation strategies, effectively allowing the policyholder to incur costs without a clear plan to reduce the overall loss. While a generous interim payment is positive, the lack of a coordinated approach to mitigation can lead to inefficient use of funds and potentially higher final claims than necessary. This could be viewed as a failure to manage the claim responsibly and to ensure that policyholder actions are aligned with the objective of minimizing loss, which is a shared responsibility. The professional decision-making process for similar situations should involve 1. Understanding the policy terms and conditions related to interim payments and loss mitigation. 2. Conducting a prompt, preliminary assessment of the likely loss to determine a reasonable interim payment amount. 3. Engaging in open and collaborative communication with the policyholder to understand their immediate needs and recovery plans. 4. Proactively identifying and discussing potential loss mitigation strategies with the policyholder, offering expertise and support where appropriate. 5. Documenting all discussions, assessments, and agreements regarding interim payments and loss mitigation. 6. Ensuring all actions comply with relevant regulatory requirements for claims handling and policyholder assistance. Question 20. Analysis of a business interruption insurance application for a small manufacturing firm reveals that the company operates in an industry with a historically high rate of supply chain disruptions and is located in a region that has experienced significant weather-related events in recent years. The applicant's financial statements indicate a recent period of reduced profitability. What is the most appropriate underwriting approach to ensure compliance with regulatory requirements and ethical considerations? Option A. Proceed with underwriting by thoroughly assessing the specific operational risks of the manufacturing firm within its industry, evaluating the actual perils relevant to its precise location, and any mitigation strategies employed, and analyzing the financial stability in the context of its business interruption resilience and recovery capacity. Option B. Decline coverage due to the high-risk industry, unfavorable location, and recent financial performance, as these factors collectively indicate an unacceptable level of risk. Option C. Offer coverage but at a significantly increased premium, citing the general risks associated with the industry and location, without a detailed analysis of the applicant's specific circumstances or financial resilience. Option D. Focus solely on the industry's historical disruption rates and the location's general weather event frequency, using these as the primary determinants for coverage and premium, while disregarding the applicant's specific financial situation. The correct answer is B. Decline coverage due to the high-risk industry, unfavorable location, and recent financial performance, as these factors collectively indicate an unacceptable level of risk. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for comprehensive risk assessment with the potential for bias, and the importance of adhering to regulatory guidelines that prohibit unfair discrimination. The underwriter must gather sufficient information to accurately price the risk of business interruption for a specific industry and location, while also considering the financial stability of the applicant, all within the bounds of the regulatory framework governing insurance underwriting. The challenge lies in distinguishing between legitimate underwriting factors and discriminatory practices. The correct approach involves a thorough assessment of industry-specific risks, the geographical location's susceptibility to relevant perils, e.g., natural disasters, civil unrest, and the applicant's financial stability as it relates to their ability to withstand a business interruption event and their overall business resilience. This approach is ethically sound and regulatorily compliant because it focuses on objective, quantifiable factors that directly impact the likelihood and severity of a business interruption claim. For instance, an industry known for its reliance on specific supply chains or susceptible to technological obsolescence presents a different risk profile than a service-based industry. Similarly, a business located in a floodplain or an area prone to earthquakes faces inherent geographical risks. Financial stability, in this context, is assessed not to deny coverage based on perceived weakness, but to understand the business's capacity to manage its operations during a disruption and its likelihood of recovery, which are crucial for determining appropriate coverage levels and terms. This aligns with the regulatory expectation that underwriting decisions are based on sound actuarial principles and risk assessment, rather than arbitrary or discriminatory criteria. An incorrect approach would be to solely focus on the applicant's industry without considering its specific operational nuances or the location's unique risk profile. This could lead to an inaccurate assessment of risk, potentially resulting in underpricing or overpricing the insurance. More critically, if the industry assessment is based on broad stereotypes rather than specific risk factors, it could lead to unfair discrimination, a violation of regulatory principles that mandate equitable treatment of applicants. Another incorrect approach would be to dismiss the applicant based on their location, without a detailed analysis of the specific perils relevant to that location and the applicant's mitigation strategies. This overlooks the possibility that businesses in high-risk areas may have robust contingency plans. Furthermore, judging financial stability solely on superficial metrics or using it as a pretext to deny coverage to businesses perceived as less established, without a clear link to business interruption risk, would be a regulatory failure. Such actions could be construed as unfair discrimination or a failure to underwrite based on sound risk principles, potentially violating consumer protection laws and insurance regulations that aim to ensure fair access to insurance. The professional decision-making process should involve a systematic evaluation of all relevant underwriting factors. This begins with understanding the specific industry's inherent risks and vulnerabilities. Next, the geographical location must be analyzed for its susceptibility to perils that could cause business interruption, considering the applicant's specific site and any protective measures in place. Finally, the applicant's financial stability should be assessed in relation to their business operations and their capacity to manage and recover from a business interruption. This multifaceted approach, grounded in objective data and risk assessment, ensures that underwriting decisions are fair, compliant, and accurately reflect the risk being insured.